In this presentation, we'll take a high-level look at 4 of the more commonly used financial statements: the income statement, the balance sheet, the cash flow statement, and the statement of retained earnings. Each statement has a unique purpose in the financial management of businesses, and it can be helpful to understand the specific roles they play. We'll look at what goes into each statement, how companies use them, the relationships between the statements, and what the SEC requires in these various statements. The first financial statement we'll look at is the income statement. This statement captures a company's income or revenues and expenditures or expenses over a period of time, such as a month, a quarter, or a year. The main components and layout would be the revenue minus the expenses, resulting in the company's net income or net losses. This statement is important because it quickly indicates whether there is a profit or a loss. The net income is often shown as what's referred to as EBITDA, or earnings before interest, taxes, depreciation, and amortization. This demonstrates the clear earnings and profitability of a company before things like depreciation and taxes are taken out. It's particularly useful for comparing similar companies and when determining a company's cash flow potential. The balance sheet is a statement with the summary of the financial balances for a specific point in time. It should demonstrate a balance of a company's assets and liabilities. The income statement is, again, a summary of revenues and expenses over a period of time, while the balance sheet is considered a snapshot of a specified time reporting the assets, liabilities, and equity. This is often done at the end of the period used for the income statement. The profits captured on the income statement will be added to the equity as retained earnings on the balance sheet. The cash flow statement captures the various sources of cash and how they flow, allowing the company to audit incoming and outgoing money. It's important to distinguish between expenses and the payables or accounts payable. Expenses are the accumulation of the cost to the company. That could include costs of goods, materials, labor, utilities, salaries, rent. The payables are capturing what you are paying or owe on those expenses. The statement of retained earnings tracks the cumulative profit. This is often used by companies to determine potential gains that the company can reinvest. The retained earnings statement subtracts any dividends paid to investors. Retained earnings are often treated as part of an owner's equity as it demonstrates the profit that has been acquired and often been invested back into the company. The SEC, or Securities Exchange Commission, requires all publicly traded companies file regular 10-Ks that include income statements, balance sheets, cash flow statements, and statements of shareholders' equity to ensure investors are routinely made aware of a company's finances and current state. This allows adequate information for investors to make decisions regarding buying and selling the securities issued by these companies. There are different ways these statements can be created to bolster understanding and aid decision-making. Common size statements create percentages from the numerical values to allow decision-makers an ability to understand how these large amounts compare. These can be used for pie charts to create visual understanding of how a company's finances are comparing. While making comparison, there are also comparative statements that often show financial information in 2 or more columns of periods of time. This allows decision makers to see how the finances of a company are changing over time. I hope you found this brief overview of the important financial statements companies use helpful. Thanks for watching.